Are you tired of feeling like you're constantly trading your time for money with maybe no real end in sight?
Yeah.
What if there was a surprisingly straightforward way to build lasting wealth and gain true financial freedom?
That's a question that really resonates with so many people, I think. And it gets right to the heart of what we're exploring today on Book Talk Finance.
Right.
We're diving into a book that has become a real go-to guide for folks seeking a simpler path to financial independence. The Simple Path to Wealth by J.L. Collins.
J.L. Collins, yeah. He has quite a fascinating backstory, doesn't he? He didn't really set out to be some kind of financial guru.
No, not at all.
His insights actually started as a series of letters to his daughter, a very personal way of sharing the financial wisdom he was figuring out.
Exactly. It just grew organically from wanting to equip his daughter, really, with the knowledge she'd need to navigate the complexities of money.
Mm-hmm.
And since then, his own journey has taken him to a more nomadic lifestyle, traveling around the globe. I think we heard he's currently exploring Southeast Asia.
Right. And it's interesting that alongside his financial writing, he also delves into themes like adversity and resilience in his work.
Yeah.
It suggests a kind of broader understanding of life's challenges, which probably informs his perspective on building financial security.
It definitely brings a certain groundedness to his advice, I think.
Yeah.
This isn't someone preaching from like an ivory tower.
Yeah.
It feels like someone who has likely faced their own financial hurdles and understands the practical realities.
Yeah, definitely. Now, before we really get into the core principles of the book, I think it's worth maybe highlighting the collaborative effort that went into making The Simple Path to Wealth happen. It wasn't just J.L. Collins working alone.
That's a really important point. A book like this is often the result of many hands and minds contributing their expertise, isn't it?
Absolutely. Take the cover design, for instance. It's quite striking.
It is.
And it was created by Carol Chu. Her website, heycarolchu.com, reveals a pretty remarkable journey. She was a White House intern back in the 90s.
Oh, wow.
And then just embarked on this life of extensive travel, living and working in like 12 different countries. Makes you wonder how those diverse experiences shaped her creative vision for this book.
It really underscores the idea that creativity and valuable skills can pop up from the most unexpected backgrounds. Her global perspective probably brought a unique aesthetic to it.
And her own book, meanwhile, back in Los Ranchos, sounds like a fun read. Illustrations, stories from her adventures. Apparently, she even has a couple of humorous tales about being arrested.
Arrested?
Yeah, once for reckless parking and another time for, get this, grave digging.
Grave digging. Okay, that's unexpected. It paints a picture of a truly adventurous person.
Right. It's intriguing how that kind of spirit might have influenced her design choices for a book that's advocating for, well, maybe a less conventional path to wealth itself.
True. Then you have the proofreaders who brought that critical eye to the text.
Yeah, one of them was Dr. Kelly Paradis. She holds a PhD in atomic physics and works as a medical physicist.
Wow. Serious credentials.
Seriously. J.L. Collins apparently joked that she might not be educated enough for the job, which kind of speaks to her level of intellectual rigor. Her website's frugalparadise.com. Having someone with that kind of scientific background checking the book for accuracy, especially the numbers, that must have been incredibly valuable.
Absolutely.
Yeah.
A scientific mind demands precision, logical consistency.
Yeah.
That's essential in a book dealing with financial principles and, calculations.
And the other proofreader was Rich Carey, a lieutenant colonel in the U.S. Air Force.
Okay.
He's had a distinguished military career, served extensively overseas with NATO, the UN, and he's fluent in both Chinese and Japanese.
It's impressive.
But what's really relevant here is his own dedication to achieving financial independence. He apparently managed to pay off his townhouse and student loans in just 6 years.
6 years. Wow.
Yeah, and he shares his insights on his website, richandmoney.com. His firsthand experience of actually doing this, successfully pursuing financial independence, it lends significant weight to the ideas in the book, don't you think?
It provides real-world validation. Definitely. It's not just theory. It's grounded in actually applying these principles.
And to make sure the book was factually solid, J.L. Collins also got help from 3 fact-checkers. All well-respected names in the financial independence community.
Oh, yeah.
The Mad Fientist, madfientist.com, and Jeremy Jacobson of gocurrycracker.com.
Okay, yeah, those are big names in the FI space. Engaging people who've built their reputations on sound financial practices adds a huge layer of credibility.
Totally. And finally, just to make sure the book would click with a broad audience, Collins had readers like Kate Schodinger review it. You can find her at roundwoodpress.com and vinoexpressions.com.
Okay.
As a middle school reading specialist and college professor, she brought expertise in clarity and accessibility, making sure the concepts were understandable even if you don't have a finance background. She jokingly described herself as no financial professor or specialist.
That's such a crucial perspective. A book about personal finance needs to be demystified, accessible to everyone, regardless of their prior knowledge. Her focus on clear communication would have been invaluable.
So, yeah, it's clear that a really dedicated and diverse team contributed to making The Simple Path to Wealth the impactful book it is.
Definitely.
Now, let's get to the core message. The central idea is really that building wealth doesn't have to be complicated.
Right. It's surprisingly simple at its heart.
It really boils down to just a few key things. Prioritize saving a significant chunk of your income.
A significant chunk. He aims high.
Yeah, he talks about aiming for 50% if you can, then consistently investing in the stock market and critically diligently avoiding debt.
That's the fundamental framework. In a financial world that often seems to thrive on complexity, Collins just champions the power of simplicity and consistency. That's the most effective path to long-term financial well-being, he argues.
And he kicks off the book with a really interesting parable, doesn't he? The monk and the minister.
Ah, yes. That sets the stage beautifully. It illustrates these two contrasting paths in life, these different attitudes towards wealth and security. One path is seemingly safe, conventional, working for a steady income.
The minister.
Right. And the other is more entrepreneurial, perhaps riskier up front, but aiming for true independence.
The monk, seeking enlightenment but also needing to provide for himself.
Exactly. It frames the whole discussion around what wealth is actually for. Is it just accumulation, or is it about enabling a certain kind of life?
Which leads directly into this concept he's famous for popularizing, FU money.
It's a provocative term, but the meaning behind it is powerful.
It is. Where did that come from? He references James Clavell's novel Noble House, right?
That's the origin, yeah. In the novel, it's the amount of money needed to be able to walk away from any situation, any job, any boss, without consequence. To just say, well,
Right. It's about having agency, control over your own life and time.
Precisely. And Collins shares his own first experience of achieving a form of it. It wasn't millions. It was actually a pretty modest sum when he was just 25.
Really? What did that allow him to do?
It gave him the leverage to negotiate his working conditions. His boss wanted him to relocate. He didn't want to, and having that cushion meant he could say no or negotiate terms that worked for him.
That's powerful at 25.
It is. And later, it enabled his wife to choose to leave her job and become a stay-at-home mom when their daughter was born, a decision they valued highly. It wasn't about being rich in the flashy sense, but rich in options.
So it's less about a specific number and more about what that number allows you to do.
Exactly. It's the point where work becomes optional, or at least the terms of work become negotiable.
Okay, so that ties back to the core principles. Achieving that FU money status relies on those simple steps we mentioned.
Yes, let's recap them because they are deceptively simple but crucial. First, save significant portion of your income. He pushes for 50%, which sounds extreme to many.
It does sound like a lot.
But the point is to make saving a major priority, whatever percentage you can manage, and aim high. Second, invest that savings primarily in the stock market.
Right, not letting it sit in cash.
Not long-term, no. Third, understand that market drops are normal. They're not just normal. They're opportunities to buy more shares at lower prices while you're still accumulating wealth.
That's a huge mindset shift for many people, isn't it? Seeing a crash as an opportunity.
It is. It requires discipline and a long-term perspective. And fourth, avoid debt like the plague.
He's really, really strong on the debt point.
Extremely. He sees it as a major obstacle to building wealth and achieving freedom. Mortgages, student loans, credit cards, car loans, he argues, they drain your resources, limit your choices, and add significant stress.
Does he make any exceptions? Or is all debt bad in his view?
He's very wary even of what's often called good debt. He has this rule of 5%, basically saying if the interest rate on your debt is above, say, 4 or 5%, you should prioritize paying it off aggressively, maybe even before investing heavily. Below that, it's debatable, but he still leans towards being debt-free.
So what about those common forms of good debt, like business loans, mortgages, student loans? People argue those are investments.
He acknowledges those arguments but urges extreme caution. For business loans, the risk is obvious. For mortgages, he points out that owning a home isn't always the great investment people assume, especially when you factor in interest, taxes, insurance, maintenance. It locks you down geographically, too.
And student loans, that's a big one today.
Huge. He warns that the landscape has changed dramatically. He shares his own experience. His entire 4 years of college cost something like $4,800 back in the day, easily paid off with summer jobs.
Wow, different world.
Completely. Today, the costs are astronomical, often leading to decades of debt that can cripple financial progress. He questions the automatic assumption that any degree from any institution at any cost is worthwhile.
So the message is be incredibly critical about taking on any debt, even the socially acceptable kinds.
Absolutely. Debt mortgages your future. Simplicity and saving builds it.
Okay, so save aggressively, invest simply, avoid debt. With this approach, he actually believes it's possible for most middle-class earners to retire as millionaires. That sounds ambitious.
It does, but he backs it up with the math, essentially. It relies on consistent investing over a long period and the power of compound growth.
Right, compound.
He gives examples like if you start early and consistently invest, say, $500 to $1,000 a month in a broad stock market index fund, the historical returns suggest that reaching $1 million or more over a typical working lifetime is mathematically quite feasible.
It requires discipline over decades, though.
Discipline and patience, yes. But the path itself isn't complex. It's about consistency, not genius stock picks or market timing.
Speaking of investing philosophy, he often references Warren Buffett, doesn't he? Buffett's famous rules.
Yes. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Which sounds impossible in the stock market, right? Markets go down.
Exactly. And Collins clarifies his interpretation. He doesn't think Buffett means literally never experience a market drop. Nobody can avoid that.
So what does it mean?
It means don't gamble, don't speculate wildly, don't sell in a panic when the market does inevitably drop. Invest in solid, broad assets like the entire market and hold on for the long term. Losing money permanently comes from selling low or investing in things that fundamentally fail. Short-term drops in a diversified portfolio aren't permanent losses unless you make them so by selling.
Okay, that makes more sense. Hold the course. Which leads to his preferred investment vehicle, VTSAX.
Oh, yes. Vanguard Total Stock Market Index Admiral shares, or more generally, any low-cost, broad-based total stock market index fund.
Why is he so keen on that specific type of fund?
Several reasons. One, massive diversification. By owning VTSAX or a similar fund, you own a tiny piece of thousands of U.S. companies across all sectors. You're essentially betting on the overall long-term growth of the American economy.
So you don't have to pick individual winners.
Exactly. You own the winners and the losers. And he calls it self-cleansing. Companies that fail eventually drop out of the index, and new successful companies are added. You automatically capture the growth of the market as a whole. Plus, the cost-to-the-expense ratios are incredibly low compared to other types of funds.
Which is crucial for long-term returns.
Hugely crucial. High fees erode your returns significantly over time.
But what about those market crashes? People get scared. 1929, 2000, 2008, they happen.
They absolutely do happen. And he stresses that they are inevitable, part of the investing journey. But his perspective is, again, long-term. He shows historical charts demonstrating that while crashes are sharp and painful, the market has always recovered and gone on to new highs eventually.
Always, historically speaking.
Historically, yes. The overall trend is strongly upward, driven by economic growth and innovation. The key is psychological fortitude. Stay the course. Ignore the noise and the panic, and if you're still saving, keep buying.
So trying to time the market, get out before a crash, get back in at the bottom, that's a fool's errand in his view.
Completely. He's very skeptical, even dismissive, of market timing and individual stock picking.
Why? Some people make a living doing it, supposedly.
He argues that consistently beating the market over the long term is incredibly difficult, even for highly paid professionals. Most actively managed mutual funds fail to outperform their benchmark index, especially after fees.
Right, those actively managed funds, that's another thing he warns against.
Yes, precisely because of their higher costs and generally worse performance compared to simple index funds. You're paying extra for supposed expertise that statistically doesn't usually deliver better results. Plus, trying to pick individual stocks or time the market introduces huge risks and psychological biases. fear, greed that lead most individual investors astray.
He uses that analogy, the beer and the foam.
Yeah, that's a great one. The beer is the underlying value of the businesses in the market, their earnings, dividends, growth. The foam is the daily market volatility, the noise, the speculation, the fluctuating prices.
So focus on the beer, not the foam.
Exactly. Focus on the long-term value creation of the businesses you own through your index fund, not the short-term froth and bubble of the market price.
Makes sense. He also talks about the big ugly event, specifically the 1929 crash. People often throw around that figure of the market losing 90% of its value.
Right, and he provides important context. While the peak-to-trough drop was enormous, around 86–89%, he challenges the idea that everyone lost 90% of their money permanently.
Also,
Well, first, that assumes someone invested everything at the absolute peak and sold at the absolute bottom, which is rare. Second, it ignores dividends, which continue to be paid by many companies. Third, for someone accumulating wealth, someone still adding money regularly, the crash was actually a massive buying opportunity. Their subsequent investments bought shares at incredibly low prices, accelerating their long-term wealth.
so for accumulators, a crash isn't the disaster, it seems.
It can actually be beneficial long-term, counterintuitively. The real disaster is for those already in retirement, living off their investments, who might be forced to sell low. That's why the strategy might shift slightly in the wealth preservation stage versus the wealth accumulation stage. He also mentions the other potential major economic disaster, hyperinflation.
Which destroys the value of cash savings.
Precisely. Which is another argument for owning productive assets like stocks, which tend to hold their value better during inflationary periods compared to cash or bonds.
So boiling it down again, the toolkit he recommends is incredibly simple.
Almost laughably simple compared to what the financial industry often pushes. Thirdly, a total stock market index fund like VTSAX or its equivalent.
Okay.
Maybe, depending on your risk tolerance and stage of life, a total bond market index fund like VBTLX or equivalent for stability.
Right.
And a simple money market fund or bank account for your emergency fund and short-term cash needs. That's pretty much it.
Stocks, bonds, cash, that's the core.
That's the core. The allocation between them might change over time, particularly as you approach and enter retirement, shifting more towards bonds for stability, moving from wealth accumulation to wealth preservation.
Which brings us back to FU money and different life stages. The strategy isn't necessarily identical when you're 25 versus when you're 65?
Correct. In the accumulation phase, you might be heavily, even 100%, invested in stocks to maximize growth, riding out the volatility. As you get closer to needing the money or achieve that FU level of security, you might introduce more bonds to dampen volatility and preserve capital. Your need for stability increases.
He also mentions target retirement funds, or TRFs, doesn't he? As an even simpler option.
Yes, for those who want the absolute simplest set-it-and-forget-it approach. TRFs are essentially a fund of funds. They hold a mix of stock and bond index funds internally.
And they adjust the mix automatically.
Exactly. They automatically become more conservative, shifting from stocks to bonds as you get closer to the target retirement date listed in the fund's name, like a Target Retirement 2050 fund. It's a one-stop shop.
What's the downside compared to holding VTSAX and VBTLX yourself?
Maybe slightly higher fees than holding the underlying funds directly, though still generally low. And you give up control over the specific stock bond allocation. You're trusting Vanguard's or whoever offers the TRF glide path. But for pure simplicity, they're hard to beat.
Now, what if your 401k at work or your brokerage account doesn't offer Vanguard funds like VTSAX or VBTLX? Are you out of luck?
Not at all. The principles are key, not the specific fund ticker. You look for the equivalents offered by other low-cost providers like Fidelity, Schwab, or whoever manages your 401k.
So what should you look for?
Look for a total stock market index fund or an S&P 500 index fund, which is a close proxy covering 80% of the market. Look for a total bond market index fund. The crucial part is index fund and checking the expense ratio. You want it to be very low, ideally under 0.10% or even lower if possible. Avoid funds with high fees or those that are actively managed.
So low-cost, broad market index funds are the goal, regardless of the provider.
Precisely. The provider matters less than the type of fund and its cost. Although Collins does point out something unique about Vanguard's structure.
Oh, yeah. What's that?
Vanguard is actually owned by its funds, which in turn are owned by the investors in those funds, people like you and me, if we invest with them.
So it's not publicly traded or privately owned.
Correct. This means there are no outside stockholders or private owners demanding profits. Vanguard operates at cost. essentially aiming to return value to the fund owners, investors, primarily through lower expense ratios. This structure gives them a built-in cost advantage compared to competitors who need to generate profits for external shareholders.
That's interesting. A structural reason for their low fees.
It's a key part of their philosophy and success.
Okay, let's talk briefly about where to hold these investments. He covers tax-advantaged accounts, right?
Yes, briefly. He emphasizes using accounts like 401k or 403bs, especially if there's an employer match that's free money, traditional IRAs, and Roth IRAs.
What's the basic difference again?
Super quick overview. Traditional 401ks and IRAs usually offer tax deductions now on your contributions, but you pay income tax on withdrawals in retirement. Roth 401ks and IRAs have no upfront deduction. You contribute post-tax money, but qualified withdrawals in retirement are completely tax-free.
So pay tax now, Roth, or pay tax later, traditional.
That's the basic trade-off. The best choice depends on your current versus expected future tax rate, but using some kind of tax-advantaged account is almost always beneficial. He also mentions HSA's health savings accounts if you have a high-deductible health plan.
Right, those are triple tax advantage sometimes.
Exactly. Tax deduction going in, tax-free growth, and tax-free withdrawals for qualified medical expenses. And after age 65, you can withdraw for any reason, just paying income tax like a traditional IRA. Many see HSAs as a powerful retirement savings tool, not just for healthcare.
Good point. What about how to invest? Like if you get a lump sum of money in inheritance, a bonus, should you invest it all at once, or dollar cost average, DCA it in over time?
Collins falls firmly in the camp of investing a lump sum immediately.
Really? A lot of people advocate DCA to reduce risk.
They do. Often for psychological reasons, it feels less risky. But his logic, based on historical data, is that the market tends to go up over time more often than it goes down. Therefore, the longer your money is out of the market while you're slowly averaging in, the more potential growth you're likely missing out on. Statistically, lump sum investing has outperformed DCA about 2/3 of the time.
So time in the market beats timing the market, even with DCA.
That's his argument. Get the money working for you as soon as possible. DCA is better than staying in cash. But lump sum is likely better still, mathematically speaking, if you can handle the psychological aspect of potentially investing right before a dip.
Speaking of timing, what about all those market gurus you see on TV or online predicting the next crash or the next hot stock?
He basically says ignore them completely. Nobody can reliably predict the future of the market.
Nobody.
Nobody consistently. The financial media often focuses on dramatic predictions because it gets attention, but if you track them, they're often wrong or they contradict each other. For every guru predicting a crash, there's another predicting a boom. It's mostly noise designed to trigger emotional responses like fear or greed.
Which leads people to make bad decisions.
Exactly. Sticking to a simple long-term plan based on broad index funds removes the need to listen to any of that.
He also has a section on the danger of being conned based on a personal experience.
Yes, a cautionary tale. He outlines 4 rules he learned from that experience.
What are they?
1. Everyone is vulnerable, maybe especially in their own area of expertise because pride can blind you. 2. Con artists don't look like criminals, they look like trustworthy people. 3. Most of what a con artist says is actually true. That's what makes the lie believable. And 4. The free lunch doesn't exist. If something sounds too good to be true,
It probably is.
it almost certainly is. Be skeptical of guaranteed high returns or overly complex strategies you don't understand. Simplicity is often safer.
Good rules to remember. Okay, shifting gears towards retirement itself, the 4% rule. That's a cornerstone of retirement planning discussions.
It is. He explains the Trinity study, which is the origin of this rule of thumb. Basically, the study looked back at historical market returns and found that if you withdrew 4% of your portfolio's initial value in the first year of retirement and then adjusted that dollar amount for inflation each subsequent year, you had a very high probability of your money lasting for at least 30 years, even through major market downturns.
So if you have $1 million saved, you could withdraw $40,000 the first year, then $40,000 plus inflation the next year, and so on.
That's the basic idea. It provides a target for how much you might need saved to support your desired retirement spending. You could flip it. If you know your desired annual spending, multiply it by 25, which is the inverse of 4%, and that gives you a rough estimate of the portfolio size you need.
Are there caveats? Is it guaranteed?
Definitely caveats. It's based on historical U.S. data, future returns aren't guaranteed, and it assumes a specific asset allocation, usually around 50–75% stocks. It's a guideline, a starting point, not an ironclad guarantee. Flexibility is key. You might need to adjust withdrawals down a bit during severe market downturns in retirement.
So a useful rule of thumb, but be prepared to adapt.
Exactly.
What about Social Security? Should people factor that into their retirement plans?
Collins discusses its history and the factors affecting its future solvency, changing demographics, political decisions. His basic recommendation is plan your retirement as if Social Security won't be there.
Really? Assume zero.
That's the conservative approach he suggests for planning purposes. If it is there when you retire, great. It's bonus income, providing extra cushion or allowing for more discretionary spending. But don't make your core retirement plan dependent on it, just in case benefits are reduced or delayed in the future.
And what about the decision of when to start taking benefits? Age 62, full retirement age 70.
He touches on it briefly. Generally, delaying benefits results in a higher monthly payout, which can be advantageous if you expect to live a long time. But it's a complex decision involving health, other income sources, marital status. His main point is, don't rely on it for your fundamental security. Build your own FU money nest egg first.
Build your own safety net. Makes sense. He ends the book on a more personal note, doesn't he? About giving.
Yes, a really nice touch.
Yeah.
He shares a story about the unexpected joy and reward that came from being in a financial position to give generously to a cause they cared about. It sort of brings the purpose of wealth full circle, not just for personal freedom, but potentially for making a positive impact too.
A fulfilling aspect of financial independence.
Indeed.
So, to wrap things up, if we had to summarize the absolute key takeaways from The Simple Path to Wealth into a few simple steps for listeners.
Okay, let's try. 1, spend less than you earn. Dramatically less if possible. Aim high on your savings rate.
2,
2, invest the surplus simply and consistently, primarily in broad, low-cost stock market index funds. Maybe add bonds for stability as needed.
3,
3, avoid debt. Seriously, treat it like an anchor weighing you down.
and 4.
4, stay the course, ignore market noise, ignore gurus, be patient, let compounding work its magic, and build your financial independence, your FU money. It's not complicated, but it requires discipline.
Save aggressively, invest simply, avoid debt, stay patient. That really is the simple path.
It is. The complexity is often just noise distracting from these core principles.
Well, we've covered a lot of ground today, really digging into the philosophy and practical advice in The Simple Path to Wealth.
It's a powerful book because its message is so clear and actionable.
Absolutely. Thanks for joining us for this Book Talk Finance. If you found this discussion valuable and you want to explore more insights from influential financial books,
We definitely invite you to subscribe to the channel and follow us for future discussions. We'd love to continue this journey of financial discovery with you.
and maybe a final thought to leave you with. Taking control of your financial future doesn't require some secret knowledge or complex scheme. It really can start with simple, consistent actions starting today.